tax returns, break-even points, and share structures today on this week's HeelanHub Weekly. Hi everybody and welcome back to the HeelanHub Weekly number 2. Hopefully you enjoyed the first ramble, and this one I'm just going to talk to you again. This is where we're really talking to you about either news, stuff we're seeing, conversations that we're having in the business with clients, and all about small business taxation, small business finance, small business in general, right? It's that kind of stuff. So 3 kind of things that stuck in my mind this week. The first one was we've had tax returns. So everybody gets a bill that they have to pay on the 31st of January if you've been successful enough to pay tax. You might also get something known as a payment on account where you have to pay up front. That generally happens when you've got tax that you owe that's more than £1,000. They ask you to pay up front for the next year. So half of that money in Jan and half of it in July. Now, if your income has changed between tax years, obviously the revenue don't know this yet, so they guess, they just think you're going to earn the same amount of money. That can be wrong. So one of the key tips, and something we've been talking to clients about a lot, is you can adjust those payments on account, but if you get it wrong, they charge you interest. So if you really don't know where you're at, sometimes the best strategy is to pay the first one and then get your tax return done between April and July when the next payment is due. Because if it's less, you'll be able to, you'll be able to submit your tax return and pay less money. If it's more, they don't ask you for any more. You still pay that second payment, and any extra would be due in the January next year. So do just get your tax return done early if you're worried about that July payment. That's the easiest way to just know whether it's correct, really. And of course, we're going to encourage you to, as accountants, to do those tax returns as early as you can anyway, because it helps you plan for that January tax bill. If you're going to get one, it's better for everybody just to get it out of the way. So do that. But yeah, if you're worried about your July payment, that's the thing to do. Now, a couple of other discussions we've had with people. One of them I've seen a lot of discussion about. We talk to limited company owners quite often about when they form their companies, what should they do with their share structures? And I'm not actually sure if we've done a detailed video on this or not, but you can set your shares up. So you, when you start a limited company, normally become the owner, the shareholder. But sometimes you might want to split those shares with someone else, like a significant other in the household, and sometimes that can be quite good for tax planning. But I've seen a couple of really bad examples where clients have formed it themselves, come to us, and they might already been in business many years, and they've got a shareholding that's split, say 50-50 with their other half. So seen a couple this week actually, husband and wife combinations, half the shareholding each. And every time so if someone said, okay, I'm going to pay a dividend of £1,000, without any funky aggressive paperwork, they need to split that 50-50. And that would be very normal. So then this person gets taxed on 500, this person gets taxed on 500. But this one over here, A, might not need the money, and B, doesn't want the money because they've already got other taxable income, and it causes them a huge bill. And this person's really the one that wants the dividend. And that can all be kind of avoided with a few different tweaks. You can have things like, you can have different types of share. They call them like alphabet shares, for example. You can call them different names. There is other ways of dealing with it. So that is something that I just want to kind of say, if you are forming a limited company and you think, oh yeah, I'm going to cut my other half in because that would be a really cool thing to do, just bear in mind the tax consequence of doing that. Now, it can be changed, so you definitely can change it later on, but it's a lot of hassle and paperwork and rewriting of articles and all this stuff just to do it, to get it done properly. So again, if you can stop that at the beginning by either forming a better share structure or not having them on it at all, depending on what you're looking like, would probably be better. Again, with all these things, if you're worried, go and speak to a professional about it and get it done properly when you form it, because yes, you can form it for like under 15 quid with Companies House, but are you going to get the right share structure, and is it going to mean it's going to cost you money later? I mean, I saw one this week that's costing somebody £18,000 because they did this. So it definitely is worth having a good look and just making sure that you're happy with what's going on. So share structures, just think about that when you go to form your limited company, or if you're experiencing this now, know there is a way to deal with it, but you just need to get some help and restructure it. So share structures, that was the other thing. Now the third thing this week, because I like to do this in threes, that came up, is looking at your break-even point. So this one's more like financially driven, but if you're, regardless of whether you think you're doing okay at the moment or you're just starting out, having an understanding of what do I need to sell, what do I need to invoice at least, if you're invoicing things, to actually break even on a month is really important, because I see this quite a lot with established business actually. They do quite well and they've got some cash in the bank, but what they're not realizing over time, they've had a bit of a downward trend, or their costs have gone up and they're not actually making any profit on paper. So their cash is slowly going down, and it takes a long time for them to realize. And sometimes if they don't have up-to-date financials, it can be too late and they've suddenly got to make someone redundant. Or actually, if we could have spotted this trend earlier and known on paper that we were losing losing money, this kind of leading indicator, we might be able to fix it and take some action and save that person's job or something like that. So understanding what that break-even point is and understanding when you're not meeting it, what that could mean in the long term is really important. I know when you start out, at the end of the day, you might think I've got a net $2,500 to pay my mortgage, so I've got to do at least that, and I've got to pay my accountant and my phone bill, right? And that might be it, and some software subscription. So it becomes really easy at that point. But the danger zone is when you start to get a bit more cash rich and you've got a bit of cash in the bank. You think, yeah, this is all right. You might take a little bit less time. The danger zone is you then take somebody on and then they're not really covering their money, but you're not really covering your money and those kind of things. So knowing what this break-even point is quite important. And there's lots of ways of looking at it. But I mean, you can do it, fag packet would have been the old term, but you could probably do it in a spreadsheet. I do it with clients quite frequently. You know, we can pull up their figures, make some assumptions and just get a ballpark. What does that figure need to look like? Just to make sure that we're comfy, that on paper at least we're making money. Now, profits and cash are two different things. You can have a profitable company on paper that ends up going out of business because it doesn't get the cash in for certain things, and the way the business model works means, you know, there's just not enough cash when you need it. Like, there's all those things aside, but for most small businesses, just have an understanding of, well, are we even making money on paper, is going to be quite a good thing, because often it starts off with you've got cash, it's fine, and then suddenly what seems like bills out of nowhere, like tax bills and VAT bills and things like that, arrive with you, and you're like, I now can't pay them. Why can't I pay them? And the answer is you've been spending the tax money to survive without knowing it, because you didn't know you were actually losing money. So understanding that break-even point is going to be quite big, but not necessarily just break-even point, but the actual sales figure you need on a monthly basis. I think it's quite cool to have that target and then either beat yourself up about it if you don't get there and think, what can we do to improve this? Or celebrate some good times and set yourself some stretch goals for your kind of growth ambitions if you've got those. But that's been popping up quite a lot as well in conversations this week. So there we go, a couple of things to look at. Early tax returns, think about your share structure if you're a limited company, and certainly understand what you've got to do as a minimum in terms of sales to keep that business ticking along and on the right path. That's it. If you've enjoyed this or you've got any comments, please do drop it below. Love reading them, and I'll do my best to get back and reply to them. Please do share this video with anybody you think needs to know the information, and I'll see you in the next one.